All right, thanks for joining us again. As we come into client review season for quarter two, we wanted to step back and take a look at what has happened so far in the markets and just revisit a little bit about our 2026 outlook. And so obviously I have Matt with me again, and we're going to pick his brain about what he sees in the upcoming year. There's been a lot of turmoil, obviously, as we've come in this year, a lot of things going on, although that just feels like a continuation of last year. So I don't know if we're ever going to get any calm really in the markets here. That's just investing. But Matt, thanks for coming on, and let's just have a conversation today about what we talked about with the outlook for 2026, and maybe catch us up to speed. You put out a blog article here recently that's going to hit our website. And I think it was done with numbers as of the end of February, but now we're recording this just a week or two into March, and things have already changed. So catch us up.
Yeah, so obviously we wrote our 2026 outlook, 2025 review about 3 months ago, got that out to clients, did a video and so forth. And then this is meant for where are we at? And so far, like you said, it's been somewhat chaotic, but markets are generally flat. We're sitting just a little under, around 1% down on the year. As of the writing, you'll see in the blog, we were up about 0.25%. We're expecting coming into this year, maybe a little pullback at the beginning of the year. We're still expecting that. However, to date, we've kind of just been flat since October. Hasn't gone up much, hasn't gone down much, and that's fine too. It has the same effect. It just might take longer to work off the crazy run we had from last April into the end of the year.
Yeah, that's right. Yeah, obviously markets can work off things by going sideways for a long enough period of time, a nice steep correction, and just get back on with it. And so far, it sounds like we're going through the first scenario.
Yeah, sideways so far. And we've already seen what's called an earnings multiple pull back a decent amount just from going sideways. And in theory, we would like to see that a little further, which would then start signaling that there's more upside room ahead. So either, like you said, Matt, go sideways longer or have this actual pullback. And that's actually where I think we're gonna head, possibly, is maybe 3 to 5% pullback from here. We don't see anything significant like last year. If you recall last year, we went down as much as 20% at one point with the spring turmoil of tariffs and a few other things. So not anticipating anything like that. Of course, it always can happen, but that's not what we're anticipating now.
Right. And of course, if it was easy to anticipate everything, it'd be easy to never make a mistake, right?
That's right.
Certainly anything can happen. As like I said, the article you wrote was as of end of February, and the conflict overseas really ramped up after that. And I'm sure you'll be talking about that a little bit here in a minute. On the blog that we put out, you added the S&P index at inflection points graph again. And was there something particular you wanted to point out about that to clients?
Yeah, I mean, really, what I like to show on that graph, and we do use that exact graph quite a bit, is that bull runs, when you get a little higher in altitude, go a lot further than what you think. And oftentimes we get a little too excited with pullbacks and think things are over. Of course, the financial media and other social medias freak out at every little thing, the world's ending and so forth. But in the grand scheme of things, we are probably closer to the end than we are to the beginning, but that doesn't mean this bull market has to be over anytime soon. In fact, if you recall from our 2026 thesis, we think we're maybe a couple more years to go, but we'll find out this year for sure, I think, if that is going to play out.
Yeah. And even the language, when you say closer to the end than we are at the beginning, that can always sound ominous, as if the end is near and all calamity is coming. And that may or may not be true. Not every market has to be a 50% pullback. Those are fairly dramatic. But the end of an economic cycle, no one can really time any of those perfectly. Just put it at that. And it's really best to just stick through those cycles and just prepare for them with having cash on the side to spend. And if you are in retirement, if you're not in retirement, having a little cash or bond ready to go and put to work when the markets are down.
And history shows that those cyclical bull markets tend to go 100% over bottom to top, or much greater than that. And we're not even to 100% yet.
Yeah.
Doesn't mean we have to do that again, but history does have a way of at least rhyming.
Well, let's just do a quick check-in, macro check-in on inflation, jobs, policy changes.
Yeah, so we just had inflation today, actually. The latest CPI report came in right on expectation, so 2.4%, so same as last month. With the war in Iran and the impact on oil, we are expecting inflation to go up next month and possibly the month after. It just depends on how quickly oil situation will resolve itself. But we will see a little bit of a bump there. It should be temporary. Prior to the war situation, we were seeing that inflation should have a little bit of a bump up early in the year anyhow, before it starts to again work its way off later in the year. The reason why that's important, obviously, outside of cost of goods going up at a slower pace, which is good for all of us, it will allow the Federal Reserve a little more room to have rate cuts later in the year. There are some other economic reasons why they may not want to do that, but we are still anticipating a couple rate cuts later in this year, after summertime, probably maybe September, October timeframe or end of year coming up. So that will be a tailwind for stocks and bonds, general consumer companies, should help better growth numbers later in the year. We just had a poor jobs report last week from BLS. However, other jobs data last week was actually really strong. And so our hope and belief that job losses has bottomed and will start to recover, we probably have to wait another month to see if that is true. We had a couple decent months in a row prior to that. And that's one of the lagging things that we want to see improve before we commit to a longer bull market, if you will.
Sure.
So that's definitely a big one. Of course, the recent events of the war in Iran, historically, here in the US, wars do not impact our markets much at all. Even a severe war or a prolonged war, our markets typically recover very quickly, especially when we aren't in a war in a recession environment, which we're in a bullish environment. So the expectation is that our markets won't be bothered too much by it. And as of now, again, the markets are only down about 1% through the first almost 2 weeks of this event happening. And the biggest reason for that is the impact on oil. So as that eases, we should see the markets ease a little bit and improve. We actually started the year with tech stocks doing really poorly prior to this. And so if those bottom out and start doing better, regardless of what happens in Iran, we probably see a better market in the coming months heading into April, May, and June, would be my guess.
Yeah. And as of this recording, I believe the oil shock is showing the potential for lightening up. Or last I had seen, we were potentially going to see some of the super tankers coming through the strait.
Yeah, a couple of things there. Oil shot up to about 119 a barrel over the weekend and early Monday morning. And by Monday afternoon had already dropped down to about 87, 88 a barrel, which is about where it was at prior to the first strikes, but still elevated from where we were a month ago. So as we see that situation, whether it's a shipment of oil through the straits improving or a little more security for that, lots of measures there that we don't need to talk about today that are going on, not just the United States, but globally. I would anticipate that we'll see more flow starting to trickle in the coming days as they secure the route a little bit more.
Sure. Yeah. Moving on, you had added in a graph about midterm elections and just seasonal patterns, and speak to that now that we're in this far to this election cycle.
Yeah, so obviously, every other year we have elections. So this upcoming is midterm elections, plenty of flipping of House and Senate seats. Regardless of how the outcome is, it creates a lot more noise than actual market concerns. Markets actually like it when there's a mixed Congress because then there won't be much policy change. Therefore, companies can project out a little better, markets can project out a little better. But historically, in a midterm election year, markets tend to peak April-May timeframe before dragging a little bit lower into the election and then run post-election. Again, it's history, but it's a pretty good historical data set. I would anticipate similar, and the reason why markets tend to trickle lower is just the unknown. And then after the election, there's a known, so then markets can react and move up. Like we've said in the past, like the presidential election this last time, markets don't really care who is elected. They just need to know who is elected so then they can adjust and move forward.
Absolutely. Yeah, certainly there can be short-term confusion or shocks as participants are figuring out what does this mean, but the certainty is the most important. Well, as we come in, into mid-year then, what does this mean for our portfolios and should we be making changes? I guess is probably the question on people's mind.
Yeah, so we're staying the course. As a reminder, we are moderately bullish. We're taking some measured risk in our portfolios between a few positions, as well as just pushing a little more to the stock side than the bond side. We believe that's the right move at the moment. Of course, if anything significant changes on the economic front, we will make adjustments, not knee jerk, but economic data is a longer term data set. So for the time being, we're still that. And if there are any major pullbacks, we just want to use that as an opportunity to probably do some rebalancing, buy some shares at a lower price for our clients would be the target goal there.
Yeah. You have any, I know you touched on it a little bit, but do you have any thoughts about interest rates on some of the cash positions we have? We've got a number of retired clients who are dependent on our cash tranching strategy where we're using T-bills and we're having to refresh those on a regular basis. And any outlook there that clients need to be concerned about or just understand?
Yeah, I think for now, rates are kind of sitting in a limbo. We've seen shorter term rates, so shorter term treasuries come down into the mid three range, so 3.6 or so, as we've been rolling some of those over from over four prior. The 10 year still sitting around 4.10 to 4.15. And especially with what's going on with Iran and oil and our debt situation and so forth, rates are staying actually somewhat high until the Fed Reserve likely cuts rates later in the year or we get a little better budgeting scenario. I think the rates will stay in that range. Ideally, we'd like to see that 10 year come down under four and stay under four because that'll help mortgage rates and other lending mechanisms for consumers. But again, then the flip side is then our treasury strategy will see a little lower return as well.
Sure. Hopefully you make that up on the equity side as they have a little more strength.
Correct.
Well, great. I think we just wrap it up there. We just wanted to give a quick update, keep this, as short as possible. Of course, if you have any questions, Matt and I and Jacob are all available to talk you through your portfolio. If you're not a client, you want to know more about what Perspective 6 Wealth Advisors can do for you, happy to take a call as well and see if we're right for your family. But with that, we'll sign off and I'll talk to you next time.
Sounds great. Have a good one.
Yep.